On one ordinary Tuesday in September 2019, something broke that almost nobody outside a trading floor noticed. The cost of borrowing cash overnight, secured against the safest collateral on Earth, U.S. Treasuries, suddenly spiked to as much as 10%. Multiples of what the Federal Reserve says that rates should be. Nothing in the economy had changed overnight. The plumbing had simply run dry. And to understand why, you have to look at a hidden system that funds almost everything else. Almost every headline about the Federal Reserve is about one thing: interest rates, up, down, held. But underneath that headline sits a system most people never see, and it runs on two words: reserves and repo. Here is the payoff up front. The Fed does not set market rates by decree. It sets them by controlling the supply of one specific kind of money, the cash that banks keep parked at the Fed itself. When that supply is plentiful, the system is calm. When it gets scarce, rates can jump violently even though nothing else has changed. Learn how that one tank fills and drains, and a huge amount of confusing financial news suddenly makes sense. So define the two words simply. Reserves are the deposits that commercial banks hold in their accounts at the Federal Reserve. Think of it as the banking system's checking account at the central bank. It is the most basic form of money there is, and banks use it to settle payments with each other. Repo is short for a repurchase agreement. It is just a loan secured by collateral. A firm that needs cash overnight hands over treasury bonds and gets cash and agrees to buy the bonds back the next day at a slightly higher price. That tiny price difference is the interest rate on the loan. Repo is the engine room of finance. It is how banks, hedge funds, and dealers fund their holdings of bonds every single day. Trillions of dollars flow through it. And the price of that overnight cash depends on a simple balance: how much cash is sloshing around versus how much collateral needs funding. When cash is abundant, the rate stays low and boring. So what happens when the cash quietly drains out of the tank? Here is exactly how the 2019 jam happened. For years after the financial crisis, the Fed had pumped the system full of reserves. Then it started reversing that, letting bonds roll off its balance sheet. This is called quantitative tightening, and it slowly drains reserves out of the banking system. By September 2019, reserves had fallen to a multi-year low of under $1.4 trillion. Lower than almost anyone realized was the danger line. Then two ordinary events landed on the same morning. A big batch of new Treasury bonds settled, which pulled cash out of banks and into the government's account. And corporate taxes came due, pulling out even more. Both are routine. On any normal day, no problem. But with the cash tank already low, that double drain left too little cash chasing too much collateral. The price of overnight cash, the repo rate, shot up. One measure went from about 2.4% to over 5% in a single day, and intraday it touched roughly 10%. The system was not insolvent. It was just out of small change at the worst possible moment. The Fed reacted fast. The New York Fed stepped in and injected about $75 billion of cash into the repo market the next morning, and kept doing it every day for the rest of the week, lending cash against collateral to push the rate back down. It worked, but the deeper lessons stuck. The Fed learned it could not know exactly where the danger line for reserves was until it crossed it. Since then, it has watched a second gauge closely, a facility called the overnight reverse repo, which is essentially a parking lot where money market funds stash spare cash at the Fed. During the flood of stimulus, that parking lot swelled to more than $2 trillion. It acted as a giant buffer of excess cash. Over the past couple of years, that buffer has been steadily drawn down towards zero as the Fed kept shrinking its balance sheet. When the buffer empties, the next thing to drain is bank reserves themselves, which is the exact setup that caused the 2019 jam. This is not just history. It is why the Fed made a decision that surprised a lot of people. In late 2025, it announced it would stop shrinking its balance sheet, ending quantitative tightening effective the 1st of December. It chose to halt with the job only partly done, having reversed only about half of the pandemic-era growth. The reason traces straight back to 2019. The Fed has said it wants reserves to stay ample, not scarce, and it does not want to find the danger line the hard way a second time. As a rough gauge, officials have suggested reserves around 10 to 11% of the size of the economy look comfortable. By late 2025, they sat closer to 13%, with that reverse repo buffer nearly empty. In plain terms, the easy cushion was gone, so the Fed stopped draining the tank. The people affected by getting this wrong are not just banks. It is anyone whose mortgage, car loan, or company funding ultimately rides on these overnight rates staying calm. So the next time you read that the Fed held rates steady, you have a sharper place to look. Not just the headline rate, but the plumbing underneath it. Are reserves ample or getting scarce? Is that overnight cash trading calmly or starting to twitch at month end and quarter end? This is a lens, not a signal. It will not tell you what stocks do tomorrow, but it tells you whether the foundation under everything is solid or stretched. The forward question to sit with. Now that the cash buffer is gone and the Fed is steering by feel, how will anyone know we are near the danger line again before the overnight rate spikes to tell us? More breakdowns of the market's machinery are on the way. This channel explains how markets work. It is educational and it is not financial advice.